Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in a half hour's time. Let's get to the stories we're following in the BNN Bloomberg newsroom. The U.S. unemployment rate sitting at 4.5%, the highest it's been since 2021. Numbers for October and November were released today, delayed by the Washington shutdown. The economy in the U.S. lost over 100,000 jobs in October, but gained some back in November. Shares of WSP Global are moving higher. The Montreal-based company has reached a deal to buy an American engineering firm from Warburg Pincus. WSP will pay $3.3 billion in cash for TRC companies. TRC sells engineering and consulting services to electrical utilities and energy firms. The acquisition would position WSP as the largest engineering and design firm in the U.S. Stellantis says it has surpassed 1,000 new hires for an upcoming third shift at its Windsor, Ontario plant. The automaker also says about 240 of those hires will be transferring from its Brampton, Ontario factory. You may recall Stellantis announced in October it would move production of a Jeep model from that factory to Illinois, putting people out of work. PayPal has applied to become a bank in the U.S., and if approved, it would help the firm bolster its ability to lend to small businesses. PayPal is also interested in offering savings accounts. The Trump administration is open to fintech companies entering the banking system. PayPal has provided access to more than $30 billion in loans and capital since 2013. Here is where we sit right now on the North American markets. The TSX down 155 points today to 30,328, a drop of 0.5%. South of the border, not a material move for the S&P 500. The Dow Jones, a 225-point drop, or almost 0.5%. The Nasdaq gaining at this hour. It's up 63 points on the day. Ottawa has given the blessing to the Tech Anglo-American deal, a merger that's been in the works for months. Let's go to BNN Bloomberg's Lindsay Biscaya. She's been joining us now with the details on that. What's going on?
Well, this is the latest in the kind of move to actually have this merger. It's not the final step, but it is a big step having the Canadian government sign off on this, approve this. Industry Minister Melanie Joly calling this a significant win for Canada. And a lot of economists saying they expected this to take a lot longer for the federal government to give this approval under the Investment Canada Act, but it came about pretty quickly. There is a criteria that had to be met, though, for this to go ahead, for the federal government to approve it, a couple of conditions, I should say. So under those terms, the headquarters of this company need to be in Vancouver, because, of course, Tech Resources is a Vancouver-based mining company. Anglo-American is based out of the UK. Most of the company's executives and board of directors does need to be in Vancouver as well, or at least it says reside in Canada. 2/3 of them need to be. The company has also agreed to secure 4,000 Canadian jobs, and Industry Minister Melanie Joly says they've also agreed to spend $10 billion in Canada over the next 10 years. They've also pledged to invest $200 million into conservation and Indigenous community initiatives. So a lot of promises to have this go ahead. And really the idea here is the federal government trying to obviously secure jobs, secure work in Canada whenever there's a merger with a Canadian company. We spoke earlier today with the executive editor at Bloomberg Canada, Derek DeCluet, and he says Barrick Mining is a really good example of what the federal government is trying to avoid this time around. Barrick Mining merged with Ranggold Resources in 2019, and we saw things change after that in terms of where the company, where most of the work and resources were within that company, and it wasn't really in Canada. Here's more on that explanation.
Yes, technically it's headquartered in Toronto, but everybody knows that the Barrick head office in Toronto has been gutted over the years, and that there's far fewer people working there, and that a lot of the decisions, really have been made in London and other places. So they're trying to, the government's trying to insulate itself from that possibility and from criticism that that's what they're allowing here.
So the primary stock listing will be in London, but the company says they'll also be seeking a stock listing on the TSX as well. We know shareholders gave approval. Shareholders of both Anglo American and Teck Resources gave their approval, and this is a big deal. These are two big mining companies coming together, a big merger. And if this was to go ahead, this merger would see about 1.2 million tons of copper produced every year.
Okay, you mentioned that this isn't necessarily the final hurdle, meaning Ottawa signing off. What is?
There's a couple of antitrust reviews that need to happen. So this means regulators need to look at this and make sure that there's no unfair competition happening here or unfair play when it comes to other competitors. So we've already had regulators in Canada and Australia approve this in terms of antitrust regulation. Still waiting a couple of regulators from a few different countries to approve it too. So we're talking Europe, China, Japan, South Korea, Chile, and of course, when it comes to Anglo American and Teck Resources, their mines combined are both mostly in Chile and Peru. So other people need to kind of look at this, make sure that it's fair in terms of competition, and then approve it. And most economists are saying they expect that to happen in 12 to 18 months. So it's not always a quick process, but as I mentioned, even the federal government of Canada approving this was quicker than what people expected. So you never know.
Okay, Lindsay, thanks for the update.
Thanks.
U.S. crude oil hitting its lowest level since early 2021, looming surplus weighing on the market. We'll dive into that when we come back. Mixed North American markets today, coming back from the red a little bit. Oil, though, down to the $55 range, a far cry from where it started the year at $80. Let's get more from Paul Harris, portfolio manager at Harris Douglas Asset Management. Paul, West Texas Intermediate crude, what's driving it down, and do you see that changing at all?
Well, I mean, I think there's been sort of this whole overcapacity, right? So you've seen a lot of overcapacity in the oil business, and you've seen OPEC come out and increase capacity or keep it where they, at an increased level and remain keep it there. So I think you've seen a lot of sort of in the United States on the shale side, you've seen a lot of stuff from OPEC. And so that's created a vast majority of the overcapacity we're seeing. And I don't think you get through that over the next, couple of months at least. So I think that's the difficult part. So I think crude could probably stay at lower levels. Saying all that, do you want to own the companies, which is what I think about. And I think that at certain, especially in Canada, these stocks aren't trading at, they're trading at 14 times earnings. They're trading at almost a 5% dividend yield. They continue to, and I'm talking about the bigger cap stocks like Suncor and CNQ. And those are the things I think in a market like this, when oil's kind of going down like this, you need to own those kind of companies because, one, they have the capacity to manage through this kind of process. The other thing is that they also have the capacity, if it happens, they're actually very good at kind of making acquisitions if they need to, when oil falls and they get an opportunity to buy a company that's maybe in distress because of the lower oil price. So I think that it's good for these bigger companies. I think they're in a better situation with lower oil prices. Saying all that, I think that, oil at some point in time settles at a kind of level and then will go up from there. But I think right now they have to get through this period where they have so much overcapacity in the oil market.
Okay, let's talk also about the Teck Resources deal with Anglo American. Are you surprised at how quickly Ottawa seems to have approved it here? And what did you think of the deal?
Well, I am surprised because, the minister kept on going on about saying she wants more concessions and all these other things. And all of a sudden, I think most analysts were taken aback that they approved it so quickly. As the individual brought up, it has to be approved by other places. But I think that's much more. I think it's much more minor because Canada, Canada's approving it was the most important thing. I think the deal makes a lot of sense. Both companies were looked at as takeovers over periods of time. Anglo through BHP, Teck with Glencore. So I think putting them together gives them much larger capacity. I think the bigger issue is what they promised, the $10 billion over 15 years. Not keeping the head office here. What does that actually mean? In the case of the gentleman brought up about Barrick, doesn't mean very much, right? So I think those are the issues that face Canada when they allow something like this to happen, whether there is some transparency and accountability to the issues that they promised. But I think putting them together makes a lot of sense. They're a bigger company. I think resources, especially on the You're talking about, certain kinds of minerals have become very, very important, not only to the tech world, but for national security. And I think they have the capacity to really grow certain kinds of businesses, especially copper. So I think that that's really important. I think it's a good deal. There is some synergies. Mining deals really don't have a lot of synergies, but there are some, not outside of head office and stuff like that, but I think there are some synergies given where their mines are, which is very helpful, I think, in the mining industry. So I think it's a good deal overall. I think that let's hope that they stick to what they've said and continue to run the business in a, thinking about the Canadian operations and the Canadian, Canada as a whole when they think about these resources, as opposed to just saying a lot of things to get the deal done and then sort of slowly hollow out a lot of these things.
Yeah, follow through on the commitments they're making. All right, we've touched on oil, we've touched on mining. Are any of these sectors ones that you favor right now?
We're not a big fan of mining as a general rule, because I think it's all really based on the commodity, and I think they've had a really big run. So it's not something that I invest in. So that's one thing. I do invest in oil. We own CNQ, we own Suncor. So I think that oil, once these, like I said, I like these larger cap companies. I think what we need to do is, when oil settles down, these companies will be able to take advantage of kind of lower oil prices if they want to buy something, but also they have the balance sheet and the capacity to continue to, they do get a lot of cash flow. They've done a smart thing, I think, a lot of these larger companies, where they've bought back their shares, brought down their debt levels, and increased their dividends. So they're in a lot better shape than they were many, many years ago. And I think they've kind of got religion with respect to how to run a business effectively on the oil side. So I think these are the companies I would want to own. But I do think that, there's a chance that you can, if you see a good opportunity at these prices for them to buy something, that would be great. The oil, I think, is fine. I don't invest in gold or any mining companies. I have not for a thing, but I do like technology still. I think there's a lot of room for something like Adobe to do well. I do like healthcare. I like financials in Canada and the United States. I think financials are going to continue to do well. There's a lot of, I think, changes in regulations coming down the pipe on the U.S. side, which will help Canadian banks. I think the low interest rate environment is helping Canadian banks and U.S. banks. So I think there's a lot of opportunity in financials. I think there's a real opportunity in U.S. regional financials as well, simply because there's way too many banks in the United States. We constantly go on about how many banks we have, such, 6 banks and all that stuff. But in the United States, they have 4,000. So there's lots of room for them to consolidate. I think the government wants them to consolidate and become bigger. And so I think there's lots of room there on the U.S. side. And I think banking is a large technology business. You really need to be big in banking to be successful, I think, going forward. So I think there's an opportunity on the retail side there. But U.S. and Canadian banks, I think, and generally financials, I think will do well over the next, going into 2026.
All right, Paul, I got to leave it there. I'm out of time with you, sir, but thanks for your time. Appreciate it.
My pleasure.
And coming up next, the U.S. job numbers are out, delayed by the Washington shutdown. A gain of 64,000 in November, but a different story in October. We'll get to that in a moment. Delayed U.S. job data was released today. There were job losses in October in the U.S., but gains in November. And the unemployment rate rose to 4.6%, the highest it's been since September of 2021. For more insight, let's go to Olo Amadunbi. He's chief economist at Huntington National Bank. Thanks for joining us today.
Thanks for having me.
So the job losses, as I understand it, are in part connected to layoffs of federal workers. But why are we seeing them now and not months ago when first announced?
Yeah, so overall, it was a mixed jobs report. It presented a mixed picture of the U.S. economy. On one hand, we saw the unemployment rate rise to a 4-year high. On the other hand, we saw faster private payroll growth. To your point, we saw a big decline in federal government employment. This is due to DOGE cuts. So many of the DOGE cuts announcements were made earlier this year, and many folks took deferred resignation offers. So many of those folks are now getting off payrolls.
Okay, so the unemployment rate move is mostly as well due to less demand for labor. Does seasonality play a role at all here?
Yeah, so I think with the employment data, we always need to look at what's happened over the past couple of months. It tends to be volatile on a month-over-month basis. What we are seeing in the labor market is some cooling. So we're seeing some cooling in demand. We're seeing softer demand due to restrictive monetary policy. Interest rates are still moderately restrictive. That's weighing on several sectors, particularly the manufacturing sector. And tariff policy uncertainty is also leading to softer demand for jobs. So, I mean, we're seeing softer demand, and we think that that's likely to extend through 2026.
Okay. One of the broader measures looks at sort of discouraged workers, those working part-time by choice, and that's up to 8.7%. So what does this tell you about the labor market?
Yeah, so you're talking about the U6 unemployment rate. So that's just one of many indicators which just captures the slower momentum in the labor market. So the U6 unemployment rate captures folks who are part-time for economic reasons and folks who have just stopped looking for a job, folks who are discouraged. And, we're seeing several signs of cooling in the labor market. Job growth has been concentrated in just a few sectors this year. The healthcare sector has been a big driver of job growth. And also just due to weaker labor force expansion. So due to the restrictive immigration policies, the deportations, those are weighing on labor supply, and that's also weighing on the broader labor market.
Let's talk about manufacturing because that moved down again. Washington wants the sector to grow, of course. It's been very focused on that in the early part of the administration. Is this tariff related?
It's partly tariff related. Tariff policy uncertainty is definitely a factor. Another factor is restrictive monetary policy. The manufacturing sector is an interest rate sensitive sector. So think of purchasing durable goods, whether that's RVs, cars, boats. Most of those items are financed, and with high interest rates, there is weaker demand for durable goods in the U.S. Now, another factor that's playing a role is weaker global demand. The Chinese economy, for example, has faced challenges over the past couple of years. China is a big buyer of U.S. durable goods, and with slower conditions in China, that's also weighed on the manufacturing sector. But the great news is that we think that there will be improved conditions next year. The Fed has cut rates by a total of 175 basis points since the beginning of last year. We think that will be a boost to the manufacturing sector next year. And also, there are several provisions from the One Big Beautiful Bill Act. We think that will be a boost to the manufacturing sector in 2026.
Okay, you mentioned earlier healthcare and a lot of the job growth coming from that sector. Why has that sector remained resilient throughout?
So there are a few reasons. So first, an aging demographic. We're seeing the retirements of baby boomers. That's creating just stronger demand for healthcare services. And also just due to the fact that there's just more access to rapid technology advances in the healthcare sector. So many folks are able to, do tests and find out information about their health conditions more so than before. That's leading to demand for healthcare. And another important factor is just strong consumer balance sheets. As consumers are getting wealthier, they can spend more on services, including healthcare services. So all those factors are driving the demand for healthcare workers.
Yeah, we do have to remember that money and how the consumer is doing will affect their healthcare. We don't worry about that as much, right, on this side of the border. You talked about rate cuts, and you think it'll be an improving environment for manufacturers in the U.S. next year. Is that because you expect a series of cuts or a deeper cut next year?
So our base case is for 1 to 2 rate cuts in 2026. We don't think the December jobs report moves the needle for a January rate cuts. The Fed has cut rates by 75 basis points this year. It cut rates in September, October, and last week. We think that the Fed will, take a wait and see approach over the next couple of months for a few reasons. First, inflation has been accelerating in the wrong direction. So we're seeing faster inflation. And also, the Fed will want to see just the effects of all the cuts over the past couple of years on the U.S. economy. So our base case is for 1 to 2 rate cuts, so 25 basis points each, a total of 50 basis points next year at max. But we think that over the next couple of months, we think that the Fed will be patient, and we think that the bar to cut rates is high at this point.
All right, Olu, I'm going to leave it there. Thank you for joining us. Olu is chief economist at Huntington National Bank. There have been recent hints about more floor crossings in Parliament after Conservative MP Michael Mah joined the Liberals last week, putting Mark Carney's government one seat closer to a majority. CTV senior political correspondent Mike Lecouture has more.
Outside Michael Mah's constituency office, a small but vocal protest demanded answers to why the Markham Unionville MP crossed the floor to the Liberals.
I feel very upset, and we fight for our future, we fight for democracy, we fight for our children.
In a statement last week, Mah said he made his decision after listening carefully to the people in his riding about the direction of the country. Sources tell CTV News the energy minister helped recruit the former Conservative. Asked if there are others ready to join the government, Hodgson would only say this.
Let's say I'm getting lots of inquiries.
Conservative Alberta MP Matt Genereux met with Prime Minister Carney in November before deciding to quit politics. That was just days after Nova Scotia MP Chris d'Entremont crossed the floor, citing Pierre Poilievre's leadership. Now, in an interview with CTV's chief political correspondent Vassy Kapelos, the Conservative leader denied he is a liability to his party.
I'm very troubled that they made that decision, but the people in their ridings voted for the Conservative agenda that I'm continually leading on in the House of Commons.
One more floor crossing would secure a majority government for the Liberals. While he wasn't able to rule out more defections, Poilievre called the move undemocratic.
If Mark Carney believes that he should have a majority to go ahead with the high-cost policies he's running on, then he should get that mandate from Canadians in an election, not through dirty backroom deals.
Even if another Conservative crosses the floor, Poilievre says he will remain at the helm of his party for his leadership review in January. Mike Lecouture, CTV News, Ottawa.
All right, let's have a quick look at the markets before the end of the trading day. The TSX Composite down 197 points so far on the day at 31,286. The S&P 500 not materially changed today. It's down 7 points. And the NASDAQ is moving up so far. It's 87 points up on the day, about 0.4%. In the movers today. When we get there, we're going to see a lot of the oil stocks moving because the price of oil has dropped to under $55 a barrel. It moved up a little bit above that lately, but we'll give that another check when we come back. Stay tuned. Here are the closing bells for the end of the trading day. Now at the NASDAQ, SS Lazio ringing the closing bell. In New York, Advertising Hall of Fame ringing the bell. You're watching the close on BNN Bloomberg. I'm Morella Fernandez. Here's how we ended the day on Bay Street and Wall Street. A bit of a mixed day on the North American markets, with the TSX dropping 219 points by end of day, down 0.7%. The S&P 500 down 16 points today, and the NASDAQ a 54-point gain, up about 0.25%. Let's get to the movers. In Toronto, Curaleaf Holdings still gaining some traction today. It jumped over 23%. That's a gain of $1.18. It's a cannabis company. There's been news in the U.S. For a change in regulation. NFI Group also a gainer today. That company gained more than 12% for the stock, $1.58 per share. Stephanie Hughes will have more on that in just a moment. And then Gildan Activewear also gaining traction today, up 5.5%. So it's up 25% on the year. A gain today of $4.54 a share to $87.15. Let's get to the losers today. Imperial Oil, $6.50 loss per share to $117.32. So a drop of over 5%. Again, the price of oil, West Texas Intermediate is down today at under $55 at one point, the lowest it's been so far this year. Celestica also losing today closer to 5%, so 4.9%. That's a loss of $20.22 a share, but it is up 181% over the last year. And then International Petroleum also losing today more than 5%, taking the share price to $23.60. All right, let's get to Bloomberg's equities reporter, Stephanie Hughes. She joined us now with some detail on this. Stephanie, NFI shares spiking today. What happened with the bus company?
Yeah, that's right. So NFI Group, which is a manufacturer of these heavy-duty transit buses, those shares, it saw shares surge by over 18% at its highest point, which was its biggest intraday advance since March, back when it reported earnings and ended up raising its forecast for the year. But what's moving the share price higher today is that the company actually earned more money than expected out of a settlement with Zalt Energy surrounding the cost of its Generation 3 battery recall. So what happened back in September is that there was an issue with the batteries with that provider, and NFI Group had to recall about 700 buses. And that forced the company to replace the entire battery packs of those buses instead of just, fixing a few components. And it had to take a warranty provision of about $229 million on its third quarter results. So today with this settlement, Zalt will cover between 75 to 80% of that provision, which was it's helping NFI recover more than analysts expected. So the National Bank team expected that NFI Group would maybe be on the hook for 50% or half the provision cost, but this was a pleasant surprise for them. They said that this was a positive outcome as Zalt is now covering most of that provision. And they said that a key component of this settlement is the fact that it includes a upfront cash payment of about $100 million. So this settlement, positive outcome, as analysts said, being well received by analysts and clearly the traders who are piling into the name today, Marella.
Okay, let's get to the price of oil, which dropped down, taking some stocks with it today. What did that look like?
Yeah, so one of those stocks that got hit was Imperial Oil. Those shares fell by over 5% today. Biggest intraday drop since April. And like you said, it's falling in tandem with other energy names today after the price of oil has been weighed as traders are kind of assessing an oversupply issue and peace talks in Europe. So West Texas Intermediate slipped below $55 a barrel for the first time since February 2021. Now, remember the context in February 2021, where it was the peak of a pandemic. Everybody was locked inside. It was very much a demand story that had plummeted. The reason why it's down is on signals that supply is outpacing demand and that there's been progress made in the peace talks between Russia and Ukraine. So the demand side is looking shaky, too, as elevated premiums on oil and gas are easing, and some weakness in the job market data are showing that are affecting demand because fewer people are actually getting in their cars and going to work implicitly, and maybe staying home to look online for job applications or making some calls. So this is all working in tandem to put some weight on names like Imperial Oil, but it's not the only one getting dinged today. We're also seeing, International Petroleum, which you mentioned in the movers, Baytex Energy, Vermilion, and a few other oil and gas names in the red today, Marella.
Okay, we will keep an eye on those this week. Stephanie Hughes with Bloomberg, thanks for that. Coming up, markets closed lower today despite sort of a mixed U.S. jobs report. We'll tell you more in a moment. Stocks continued their recent trend today as Wall Street responded to delayed American November jobs numbers, which offered some mixed signals about the economy. Let's go to Paul Christopher, head of global investment strategy at Wells Fargo Investment Institute. Thanks for joining us today.
My pleasure. Thank you.
Let's start with West Texas Intermediate crude under $55 at one point today. Do you see oil regaining anytime soon?
No, not really. I mean, there's some traction to be gained, we think, later next year as the U.S. economy and the rest of the world actually accelerate some. But we're in a slow spot right now, and so a fall in oil prices is to be expected.
Okay, let's get to the jobs data coming out of the U.S. Did you see anything that would have moved the Fed to cut deeper?
No, not deeper, but just confirming for them that they should be paying more attention, we think, to the labor market than to inflation, which is, albeit sticky, but not really going higher.
Okay, explain from your perspective those numbers. We saw job losses in October, some gains, but not the same kind to offset in November. How would you characterize what you saw?
Yeah, so the bottom line here is that the jobs picture remains weak. Firms are not employing a lot of new people. They're also not laying off a lot of new people. So we're seeing new claims, initial claims, continuing claims. Those are still looking okay. And an unemployment rate of 4.6% is still very low. But the decline in October, that really associates, we think, with the shutdown of the U.S. government. The rebound in November, offset by revisions to previous months. But let's keep our eyes on the ball here. The economy is still in good shape. The retail sales numbers will tell you that. We're just not seeing a lot of new hiring. Again, not seeing a lot of firing either.
Okay, is any of the sector-specific information troublesome to you? The manufacturing sector being dragged down, for example?
No, and if you look at the PMIs that were out, also you get a picture of slowing but not collapse. And again, that's right in the lane that we've been calling for. A slowdown in the fourth quarter, aggravated by the U.S. government shutdown. We think by the time we get to tax refund season next year, February, March, April, you're going to see a considerable stimulus come from very large tax refunds, probably some of the largest in recent memory if you exclude the 2021 pandemic and the payouts.
Will that look like hiring, though?
Well, what you'll see happening is a convergence of trends. Even if you leave aside AI spending, tech spending right now, you've got deregulation, which we think is accumulating momentum, and that's going to be cost cutting and helpful for small businesses who, by the way, create 70% of the new jobs in the U.S. as it is. So deregulation, that's going to help them. Lower interest rates especially will help small businesses. That has been a real anchor around their necks now since 2022. And then you get the tax refunds and maybe even tariff effects start to fade as we go forward from here. Those have also hit small businesses harder. And we see 5 out of the last 6 months in surveys, small businesses say they plan to increase hiring. We are looking for a stronger job market and a stronger economy as 2026 progresses. But between now and maybe the middle of the winter, it's not going to look very good.
Okay. Let's talk about what else is feeding into the volatility in the market. Besides job numbers, what else do you see feeding in?
Just there's still some profit taking going on from the tech sector. And we had those couple of disappointing news items last week from big tech companies. The investors are still digesting what this trend going forward means. And even if the tech spending has strong momentum going into 2026, and we believe it does, there's still longer term questions out there that will come up probably every earnings season about whether or not the adoption rates will justify on the back end the spending that we're seeing on the front end. So some really good caution on the part of markets, not really getting too carried away with themselves. And this pullback, we think, is going to create some interesting opportunities for buying going forward into 2026. We are looking for not just tech spending to drive markets. Here we're looking for a broadening of earnings growth, a broadening of participation, especially with low interest rates and earnings coming up. We think $300 a share on the S&P next year. That's 11% gain, and it's going to be broader than just tech. So this is a time for investors perhaps to be looking for opportunities, looking for values. Our favorites right here are utilities, industrials, and financials. We see good valuation there, and we see them participating, not just in the tech spending trend as sort of ancillary sectors, but also as part of a general and broader economic recovery in the U.S. and North America and in the world, too.
Okay, so I was going to ask you, which one is sort of a tech play, but a broader tech play?
Yeah, exactly. Utilities and industrials. You think about utilities, a 12-month forward PE closer to 20, whereas information technology closer to 28 to 30. So if you're looking for a way to play tech, but in a cautious way that's value-oriented, think about the data centers and utilities and industrials. the financials could participate in there too, insofar as they're lending to help create those data centers.
With the one big beautiful bill coming and deregulation coming through that, I'm wondering if you see a specific sector that you like that will take advantage of that.
Oh, all three of those: industrials, utilities, financials. Financials are most favorable. The steepening of the yield curve also helps financials. That's an economic factor independent of the pace and the momentum behind the tech spending.
Okay. In that case, I will leave it there. Paul, thank you for joining us. Appreciate your time.
Thank
Paul
you very
Christopher,
much.
Head of Global Investment Strategy, Wells Fargo Investment Institute. Kraft Heinz announcing a new CEO. And our next guest says they believe he's skilled to lead the company through their coming split. That happens next year. More in a moment. Former CEO of Kellogg Company, Steve Calhoun, has been named the CEO of Kraft Heinz. We have more on this with Aaron Lash, Director of Consumer Equity Research at Morningstar. Thanks for joining us today.
Thank you for having me.
So he'll lead the company, but the company's actually splitting into two next year. Which one will he oversee?
He's going to oversee the global sauces, seasonings, and spices business when the split takes place in the second half of 2026.
Okay, but that being said, he will be, I guess, up to his hips in it with the split of the company?
Yes, and he has seemed to indicate that there is the opportunity for change now, meaning opportunities to reincite growth, particularly volume growth, given the strong brand portfolio that Kraft Heinz already operates with.
Okay. Is he, in your mind, the right fit for this role?
He has experience doing exactly what Kraft Heinz needs. Kellogg had been struggling for some time as well. He was able to reinvigorate those brands and also see the business through a split, which took place in in 2023. And that business, both of those businesses, have since been acquired for fairly attractive valuations. That's not to say that that's ultimately the course that Kraft Heinz will go down, but he has experience reigniting brands and orchestrating a split, and so he seems like a great fit. In addition, he has more than 30 years of experience in the consumer staples space, which is a vast array of knowledge and experience to draw from.
Okay, so Aaron, remind us why the company said it's going to split.
The firm has been challenged to grow volumes, not dissimilar from a number of operators across the space. But there has been an increased appetite for dividing businesses, particularly when shares have languished. We've seen that for the last 10, 15 plus years. And from our vantage point, the opportunity or the motivation is really behind trying to unlock a higher multiple for a more attractive piece of the business, though management contends that it will also afford the opportunity for increased focus and thus the ability to really focus resources, both financial as well as personnel, on the highest return opportunities.
Okay. What I noticed was neither of the new companies are going to carry either the Kraft or the Heinz as part of the name. Why move away from that? I mean, those are the brands that are popular and well known.
So neither of the official brand names or company names, have been announced as of yet. So it's possible there could be a component of Kraft or Heinz mixed in there. But right now, the businesses are being termed in terms of their specialty and their focus, meaning North American grocery and sauces, spices, and seasonings.
Okay. When you pull companies apart this way, I'm just wondering what challenges are going to face, because when you bring companies together, you look at synergies, you look at savings, and that's good for investors. But when you're pulling them apart and dividing them, what are the challenges moving forward?
It's making sure that execution continues, meaning that they are continuing to get product to shelf and being good partners for the retailers that stock their products, both in physical outlets as well as online. It's making sure that the innovation doesn't miss a beat, that they're still attuned to consumer data and analytics and keeping pace with evolving consumer trends. Those, not losing focus on the areas and the aspects that truly strengthen that brand and tangible asset is really at the center of what the firm is likely to be focused on as they are dividing these businesses.
Is this a company right now that has been good with innovation, has been good with keeping up with the trends?
I think that there has been fits and starts as it pertains to innovation. There is arguably has been some low-hanging fruit. If you think about Capri Sun, just recently, that product moved away from the pouch and into larger pack sizes, smaller pack sizes, things that have expanded the opportunities from a distribution perspective that hadn't been pursued previously. So that's a great opportunity that likely has more legs. There's also opportunities as it relates to flavor profiles and additional changes in pack sizes across other areas of the business. They've been coming out with new flavor profiles for Kraft mac and cheese. They've been doing so as well as it relates to Philadelphia cream cheese, moving that beyond a spread for bagels and more as an offering that can be used for dips and other occasions. So there still is a wealth of opportunity, it seems like, as it pertains to innovation that will continue to evolve as consumer trends do.
I imagine that the move away from processed food would also be a big challenge for them.
It can be a challenge, absolutely. But if you think about it, Kraft mac and cheese, for instance, removed artificial flavors and colors from their mix about 10 years ago. They ran what they term the largest national blind taste test by not telling anyone for 3 months after launch. Since that time, they haven't done probably the best job of touting the extent to which that product doesn't maintain artificial flavors and colors. But those are our opportunities to continue to refine the portfolio. The other component of that is that consumers sometimes say one thing and want another. And so purchase patterns and intentions don't always match. And consumers sometimes associate a healthier product as tasting worse. And so it behooves Kraft Heinz to ensure that the taste profile of their products maintains, it stays consistent, or risk losing even more volumes if consumers balk.
Yeah. Aaron Losh, got to leave it there. Thank you for your time. Aaron's Consumer Equity Director of Research at Morningstar Research Services. Coming up, WSP strengthening its position in the power and energy sector, acquiring a new company. More in a moment. Welcome back. WSP Global has announced that it's going to buy TRC Companies, all-cash deal, worth $3.3 billion U.S. It comes as the company continues to push its position in the power and energy sector. We were joined today by WSP Global CEO Alexandre Leroux.
The acquisition of TRC, combined with the acquisition of Power Engineer that we completed a bit more than 12 months ago, will really cement our position as the undisputed leader in the transmission distribution space in the U.S.
And you also say that this is going to make you the biggest engineering and design firm by revenue in the U.S.?
Yeah, with this acquisition, 8,000 people and $1.2 billion U.S. in net revenue, we are now, by total revenue, we are now the largest firm in the U.S. in engineering and design. So quite pleased about our position now.
Sorry, Alexandre. So you're bigger than a Fluor or a Bechtel or a Jacob Engineering?
Well, we need to be careful not to add the gross revenue of the contractors. But if you really take the pure engineering firm, like the Jacobs and AECOM and others, indeed, our total net revenue exceeds those of the firms that I just mentioned.
You are selling some stock here, at least 850 million in shares. Is that in Canadian dollars or US? Can you clarify for me?
That's in Canadian dollar.
Right. Okay. But you basically, how will you finance the rest of the purchase price here?
It's just bond, public bond, and debt financing that was secured just prior to the transaction.
So obviously you're pretty excited here. I mean, the electrical build out in the United States is just stupendous, in large measure because of the power needed for data centers.
Exactly. I mean, and we need to remember that data centers, despite the hype that and everything that we hear around data center, it's still to this day a small portion of all of the electricity consumption in the U.S. And in Canada, for that matter. So we really wanted to position our firm at the forefront of not only the energy transition that is taking place, but the energy addition that is also taking place. All the transmission line, the average age of the transmission line in the U.S. are about 30 to 40 years old. So they're all going to have to be replaced. Connecting new transmission lines to existing grids or new grids will also be a real opportunity for us. And similarly in Canada, I mean, the average age of the transmission line are quite old. So all of that will have to be replaced, but also new grids will have to be designed. So we're quite hopeful that we have entered in the last 24 months in a very high growth area for the company.
Do you find you're turning away business in the electrical area with such a big build out?
There's a lot of work, and we expect that a lot of work will take place over the course of the next decade. If I look back at the TRC track record on organic growth over the last 4 or 5 years, CAGR of anything between 11 to 12% of organic growth. And similarly, a year ago, the acquisition that we completed in Power Engineer was a similar track record. So we're quite hopeful that this will go on for quite some time.
Did you ever think you'd see such excitement about electricity? I mean, for decades, there was really very little growth in electrical demand in the United States and Canada.
You are right in saying that. But as I just said, I just mentioned, Power Engineer, for instance, for the last decade, they've been growing at north of 10% just organically over the last decade. So I think maybe this wasn't discussed as much, but really the aging infrastructure that the U.S. is faced with is something that will need to be tackled. And I see this as a real opportunity for us to expand the scope of services that we can offer to the major IOUs in the United States.
Alexandre, Canada, lots of other countries, including Britain and Ireland, people are frustrated at how long big engineering projects take, partly because of bureaucracy and an endless process of public approvals and NIMBYism. Do you think times are changing, though, that it is possible to speed up these big developments?
Well, the proof is in the pudding. So I feel that now all of our governments are well-intended. They're well-intended to expedite the approval of large infrastructure projects in the U.S., but also in Canada. And we see it not just at the federal level, but also at the provincial level. So time will tell, but at least I have not seen that level of intention and the desire to speed up infrastructure projects or the approval of infrastructure projects in a long, long time. So I think that's all very positive.
Now, you yourself are a financial type. You joined WSP as CFO when you became, in 2010 you came in, and then 2016 you were promoted to president and CEO. Do you find it difficult sometimes talking to engineers? Do they try to baffle you with their engineering jargon, whereas you're a financial guy?
Well, look, I always like to say that I'm surrounded by people that are much smarter than I am. So, but at the end of the day, I feel that we're very complementary. I think I bring a lot of skill set to the table and to this firm. And I do feel also that our people are bringing incredible domain expertise to our clients. So I think it's been an incredible marriage for all of us. And it's an honor for me to lead this team.
Alexandre Leroux, CEO, WSP Global. When we come back, Xanadu Quantum Technologies will receive $23 million, part of Ottawa's new Canadian Quantum Champions program. More in a moment. Ottawa is launching a new Canadian Quantum Champions program, with Toronto-based technology company Xanadu getting $23 million, part of the project. Canada is looking to keep tech in Canada through the initiative as global competition ramps up. Now, we were joined today by Xanadu Quantum CEO Christian Wiedbroek.
It increases the probability that we stay here in Canada. I think historically, I'm originally from Australia, and historically, I've learned that a lot of great skills and people have left to go south of the border. More recently, we've seen that with the artificial intelligence community. We can't let that happen with the quantum computing community. And so I see this as a way to make sure we stay here and make sure that the IP and talent stays here in Canada. And Xanadu is one of the largest quantum companies in the world. And 4 of us in Canada actually got this money. So that's how I see it. And it's about not repeating the same mistakes in terms of the brain drain of the past.
And I'm going to ask about that in just a sec, but I want to go the other 3 companies, Anion, Nord Quantique, and Photonic. Do you see any synergies, any opportunities? Would you be working with them with this money, or are you going to stay completely separate?
I think with all of us, we all have 4 different approaches to building a quantum computer. And that really shows you the talent that we have in Canada. So we'll always look to partner up, particularly with our friends here in Canada. But for the most part, I think this is more about really doubling down on 4 major approaches that the different Canadian companies offer to the world.
And where's your direction? Where are you heading, and where will this money help take that?
Yeah, at Xanadu, we're actually building quantum computers using photonics or light. It's a very unique but very beneficial approach to building a quantum computer. And the $23 million for us at Xanadu allows us to ramp up our spending, which would be used to hire many more people and also accelerate our innovation and growth here.
And now you mentioned you wanted to stay in Canada, the importance of staying in Canada, but you're also in the DARPA competition in the U.S. with the American Defense. And I think you've got $16 million in funding. You made it to that round, and the possibility of $300 million. What kind of a pull will that have for you to relocate, or would you be forced to relocate if you get through to that next round?
To our knowledge, there's no need or pull for us to relocate up until Phase A and Phase B, which you mentioned we got into. Phase C is really the $300 million carrot, but there's been no talk for us to actually move. Another thing that's important to point out with our discussions with Minister Solomon, who's been the real champion behind this, is Phase 1 or Phase A of the Canadian Champions program is actually the same as Phase A and B of the U.S. QBI program. So it's really one of these rare instances where the Canadian government is actually outdoing the U.S. government. So, we're hopeful for this is just the start of funding. And we're really excited to see what Canada will be sort of giving to us and other companies for future rounds.
And are you confident it would be confident enough, even if you do advance with DARPA, that you'd be able to stay here and want to stay here?
That's 100%. We've always wanted to stay here. We're into our 10th year now. We've hired over 260 folks, so 85% of them are based here in Canada. We'll continue to do that. The talent is here. The money is here as well. As we can see the government stepping up here. We've raised a lot. And so we have no plans to go. The pull is always there. The US is obviously bigger and has a different mindset sometimes, but we want to do the same sort of thing that others are doing in the US and doing here at home in Canada.
And what's the latest on the IPO with the SPAC merger with Crane?
Yeah, thank you for asking. Exciting time for us and our team here. The latest really is it's in the hands of the SEC now, and we're looking excitedly waiting for comments from them to go on to the next stage.
And what would be the next stage? I mean, again, isn't that not another lure to go south?
Well, the good thing there is we'll be actually listing on the NASDAQ and the Toronto Stock Exchange. So we're proudly Canadian. We'll be dual listed. But no, nothing changes our mind. We'll be headquartered and listed both in the US and Canada.
And a bigger picture, getting the funding that you're getting in the other companies, does this really help strengthen and does this draw interest from around the world for quantum computing in Canada?
Yeah, for sure. Many people may not know, but the Canadian government, through universities and so forth, have been supporting the talent side of things for the last 2 decades or more here in Canada. So it's important that we leverage it and commercialize it. And it really does keep us here. But as the government has said, this is just a starting point of funding for the 4 companies here in Canada and potentially more. And we anticipate to see much more funding come our way and the other companies as well here in Canada, further strengthening our ties here.
And are we getting close to seeing some, I don't know if you can call it a physical product with quantum computing, but are we getting close to something that will be out?
Yeah, so we have quantum computers available already the last few years, and we continue to have them. We have them available online so people can actually access them wherever they are in the world and utilize the internet to access our state-of-the-art quantum computers. We've had 2 big Nature paper publications this year. We are at the forefront anywhere in the world, and that really shows you what Canada is capable of doing. They need to be bigger and more powerful, and so that's really the reason why we're going public, is the access to capital that we can improve them and speed up our process. So stay tuned. These powerful quantum computers are coming in the next few years.
Christian Wiedbroek is CEO of Xanadu Quantum. When we come back, a former Bank of Canada deputy governor says the country needs to reposition to get through tariffs and years of underperformance. Back in a moment. As we end the year, we look ahead to what's next for 2026. Bennett Jones has released their outlook, showing new realities of the U.S. and Canadian economies. We're joined by Paul Beaudry now, Senior Economic Advisor. Bennett Jones, also former Deputy Governor of the Bank of Canada. Thanks for your time.
Thanks. Happy to be here.
Was a 2025 story, you think, more about AI or more about tariffs?
Well, I think the surprise part was the role of AI, in the sense that tariffs still for Canada is really big story, and we were kind of seeing it coming and everything. But I think the aspect of the size of AI and how big it's become, especially in the U.S., and how it's transforming, whether we're kind of in a bubble situation or not, or whether we're in a transforming economy, that's a really big change. If you look back a year ago and there was discussion on that front, that was a kind of a small aspect. And so it's certainly the biggest news over the year, but still for Canada, tariffs is a really big kind of issue.
How do you see then the AI story evolving for next year?
Well, this is it. There's really risk on different sides. When you really look at the amount of money being put in and try to calculate whether it's the firms that are putting that money in that will actually be able to recoup enough of a return to justify the values that they have on the stock market, is, it really takes a bit of optimism. It's possible. There's kind of reasonable scenarios where it could happen, but it's quite optimistic. That's even in the case where AI itself gets kind of taken up a lot. Up to now, we're seeing AI being taken up in small parts and everything. There really has to be kind of a movement more widely and really kind of having revenue kind of coming in to support this amount of investment in the background. So we'll really see. It's a risky situation. My guess is it'll continue on for a while because there's a lot of momentum, but people should also have a good look there of what firms are really kind of creating a market for their product.
I'm going to lump tariffs and CUSMA together, and I'm wondering how you think Canada needs to position for 2026. We're going to presume that there's going to be a CUSMA negotiation, although that is not necessarily confirmed.
No, you're exactly right. We don't know, but I think that's the right way of kind of posing it, that there will be some kind of renegotiation along that line. I think it really is to the gain of Canada right now. We've been kind of patient on many of these fronts. It's, for a lot of people might be worried, it's taking a long time to get a new kind of deal and kind of starting to get that renegotiation going. But at the same time, the costs of tariffs are starting to show up in the U.S. And so there's going to be more and more pressure to kind of relieve some of those costs. And that's a good situation to be in when kind of renewing or kind of rediscussing CUSMA, as there's kind of the understanding of the cost of kind of putting up these tariffs. And so I'm actually still optimistic that reality of the cost of tariffs, the value of Canadian products for the American consumer, and a lot of our products go through firms, but indirectly kind of benefit the American consumer. That's going to be a push. And as we get more political pressure, maybe we can get a reasonable deal. Now, at the same time, we have to expect that there will be asks from the Americans. There will be things that we'll have to give up. But yeah, hopefully we can get something going on that front.
Better or worse, do you think, if we stay in a scenario where CUSMA doesn't necessarily get renegotiated, but Canada escapes a lot of the tariffs from the current agreement? Or does that just add too much uncertainty to the forecast?
Well, it's certainly, uncertainty is never a good thing. So having a lot of uncertainty about CUSMA is not a great thing. But if it's kind of stayed where we are right now, what we have right now is a situation where a lot of goods do not have high tariffs. We're one of the countries that have the lowest tariffs with the U.S. right now. So overall, it's not a horrible situation. The uncertainty about that makes investment kind of really a lot of people reluctant to invest. It also makes certain sectors, as we know, there's certain sectors that are really hurting in Canada, whether it be the auto sector, the steel sector, aluminum, wood. So we have sectors that are being hit. But again, in some of those subsectors, I do see the room that maybe some of those tariffs could be reduced. We're getting some of the pressures, again, on costs of things like steel, aluminum for the Americans are pushing things up. Maybe we can get a better deal on that front. But, if we could kind of keep an average tariff rate as about the levels we have right now, it wouldn't be a too bad thing for Canada.
Sometimes just flying under the radar seems to be best in these situations. What about the private sector? We've talked a little bit about what situation the government will be in looking ahead. What about the private sector? What do they need to focus on next year, or what needs to happen there?
Well, on a lot of those fronts, as we're seeing, there's kind of a new atmosphere that's coming out of Ottawa. Hopefully it's supporting more the idea of needing to invest, and that investment really has to come from the private sector that comes and supports and kind of develops things. Certainly on the energy front, we're getting a kind of new view. Again, when we think about AI in the U.S., a big part of AI build out will really require more energy, and so anything that Canada can kind of help and contribute on that aspect will be possibly positive. Obviously, we want to diversify at the same time, but that doesn't stop from the idea that maybe we can kind of help bring new goods or new energy up to the U.S. too in the future as AI needs it.
What do you think the U.S., on the flip side, needs to focus on for 2026?
Well, I think it's kind of the affordability issue. We've kind of seen it. Not that Canada doesn't have an affordability issue, but there's really an affordability issue also in the U.S. in this aspect of having tariffs that are increasing the price of a lot of things. We're seeing the labor market slow down in the U.S. Those are all things that are kind of saying, maybe rethink about the economic strategy they have to really help on affordability.
Okay. I'm going to leave it there. I'm out of time with you, sir, but thank you very much for joining us. Paul Beaudry, Senior Economic Advisor now at Bennett Jones. Time for Hot Picks coming up next, we were joined by Jed Ellerbrook, Portfolio Manager, Argent Capital Management. And we kick things off next with the bull case for Microsoft when it comes to AI.
Microsoft Azure is the fastest growing cloud computing business in the world. Their big customer, OpenAI, is seeing rapidly rising usage and workloads. Azure benefits from that. Microsoft is also able to hold in their operating margins despite that really strong growth, which is something most cloud computing companies have been unable to do. Oracle is struggling with margins going down a little bit in exchange for that big revenue growth. Microsoft doesn't have to do that trade-off, so that's great. And then finally, Microsoft's software business is also performing well and growing consistently. So I think Microsoft is really firing on all cylinders today. Revenue growth accelerating, margins holding in, continued strong investment in data centers that are generating a clear ROI.
You say that Microsoft is aggressively building out data centers to handle its enormous computing needs, but they're doing it in a prudent way?
They are. Yeah, they are. All these companies, all the cloud computing giants, Microsoft, Amazon, and Google, they all have more demand today than they can satisfy. And more supply comes from opening up these big new AI data centers that are under construction all over the world. And so they are chasing demand, but they're doing it in a prudent, responsible way. They're making sure that they build data centers that will be fungible and usable for a variety of different workloads and tasks. And they're not just building anywhere and everywhere they can get permitting.
Let's get on to your next player, and it wouldn't immediately leap to mind as a tech stock, but it's Apollo Global Management, private equity giant, and they are becoming a major player in data centers.
They are, yeah. Apollo has expanded recently into the financing of data centers. I think that Apollo is a compelling stock because the valuation has come down as the stock underperformed in the first half of 2025, or maybe even first 3 quarters of 2025. It's since started to rebound, which has been nice. But I think the company is seeing really strong demand for their alternative investment products. And they've also got an upcoming fundraising cycle that's going to boost their growth in 2026 and 2027 as well.
Right. I mean, they've teamed up, they're teaming up with our own Brookfield, among others, Apollo Global. How much of is a big part of their asset base now focused on tech?
It's still pretty small today, but it's growing rapidly. 80% of Apollo's business is private credit lending. And the infrastructure group focused on data centers is a small chunk of that, but growing pretty rapidly. And I think that private credit, there's been a lot of fears with regards to that. A couple higher profile bankruptcies, mostly tied to the auto sector, have really soured sentiment on private credit lately. And I think that those fears are overdone and will be disproven over the next couple quarters with just consistent execution from Apollo and Brookfield and other private credit companies.
And then finally, Tyler Technologies. Just remind us what they do and what has caught your eye here.
Yeah, Tyler's a niche business that most people have not heard of. So they provide technology services to cities, municipalities, counties, and states, mostly in the United States. So that is a relatively slow-changing, slow-to-adopt technology, unsophisticated client base. They need help managing the operations of their communities. So that might mean utility billing systems, accounting, courts and justice software systems. And Tyler provides all of these things. They're kind of the best-of-breed supplier to this particular niche. They have about 50% market share. They've been growing that market share over time, and they're highly profitable, so they can reinvest in adding AI functionality on top of their existing software. And I think that their client base is going to be eager to adopt those AI add-ons over the next few years.
That's interesting. And so when you say an AI add-on, what is that? Just remind us.
Yeah, sure. So it's oftentimes something simple. Instead of filling out a long form online to rent out the gazebo at the local community park, it might be a more like kind of chat interface, like a ChatGPT style interface that's easier to use, self-service, quicker for consumers to use, and results in a slightly happier community. And cities and states all around are going to be adding functionality like that to make things greater self-service, so they can employ fewer people in call centers and help desk positions.
Jed Ellerbrook, Portfolio Manager, Argent Capital Management. Here is where we ended the day on the North American markets. The TSX dropping 219 points today, so down 0.7% to 31,263. Not a big move for the S&P 500. It dropped 16 points today, about 0.25%. And then the NASDAQ composite moved up today, so 54-point gain, or about 0.25%. And end of the day at 23,111. Oil stocks were hit today by the price of oil. West Texas Intermediate dropping at 1 point below $55. Even $55 mark is a low for the price of oil on the year, so we're keeping an eye on that. Thanks for joining us today on The Close. Know Your Options will be back tomorrow at 3 p.m. And until then, we'll see you for The Close after that.